Welcome to the deep dive. Ever wondered how government finances are tracked? It's a really unique world, quite different from your typical for-profit business.
Absolutely. Miles apart, really.
So today, we're diving into governmental fund accounting. We'll be looking specifically at how they, handle budgeting and account for their day-to-day activities.
We'll cover their budgeting approach, how revenue gets recognized, things like taxes and grants, which is a big part of it.
And also how they track spending and even how they deal with those big-ticket items like buildings or maybe long-term debt.
Exactly.
Our goal here, it's really to give you a clear picture of this system, which is fundamentally built around accountability, not profit.
Yeah, think of it like understanding the specific rule book for public money. It's less about the bottom line and much more about making sure funds are used correctly as intended.
Okay, let's start with budgetary accounting then. For those main governmental funds, you sometimes hear the acronym GRAS-PP used for them.
Right. The general fund, special revenue, and so on.
For those, the budget is really, paramount for controlling spending.
It absolutely drives the process.
And what jumps out immediately is just how different this is from the commercial world. There's no profit goal, no traditional income statement.
And even core accounting ideas get tweaked. The big focus is on sticking to that budget, tracking activity against it, and this concept called encumbrances.
Encumbrances, like setting money aside.
Sort of like earmarking funds before you actually spend them, yeah. It's another control mechanism.
What's really interesting, though, is how they formally bake the budget into the accounting system itself.
That's a key point. They use specific budgetary accounts, estimated revenues, what they're allowed to spend, called appropriations, and this balancing account, budgetary control.
So they actually put their plan, their estimates, right onto the books.
Precisely. At the start of the year, they'll make journal entries. They debit what they expect to get estimated revenue control.
Okay.
And they credit what they plan to spend, appropriations control.
And the difference goes where?
Into that budgetary control account. It acts like a plug figure. It's a really proactive way to manage against the plan.
Setting the financial guardrails, as you said.
Exactly. And then end of the year, these temporary budget entries, they just get reversed out.
Okay, so that's the plan. Now, how do they track the actual activity, the money coming in? Our sources emphasize this focus on the flow of current financial resources.
Right. It's very much focused on the current year, the annual budget cycle. It's often called modified accrual accounting. It's kind of like cash basis, but with some important modifications.
Especially with revenue that isn't a direct exchange, right? Which is a huge slice of the pie for governments.
Oh, absolutely.
Yeah.
Governments get tons of money through what we call non-exchange transactions, not like a shop selling you something.
You mean like income taxes, sales taxes?
Exactly. Those are derived tax revenues.
Yeah.
Then you have imposed ones like property taxes or fines, and of course, grants from other government levels.
And just because a tax bill goes out, that doesn't mean they recognize the revenue immediately, does it? There are specific rules.
Definitely not automatic. There are time requirements, basically. Is the money intended for this period? Can it be used now or must it be used now?
Okay.
And for some types, especially grants, there might be eligibility rules. Does the government qualify? Do they have to spend the money first to get reimbursed?
Right. And there's this key concept, measurable and available. What does that mean exactly?
It means two things. Measurable, can they reasonably estimate the amount? And available, do they expect to collect it soon enough to actually pay this year's bills?
Soon enough, meaning?
Generally, the rule of thumb is collected during the year or within about 60 days after the fiscal year ends.
Got it. So it's not just owed, it has to be realistically collectible and usable soon. Our sources mention property taxes as a good example, showing entries for billing, collecting, handling overdue taxes.
Yeah, and accounting for amounts they might not collect.
And what if they get cash, say a grant payment, but haven't met all the rules yet to call it revenue?
That's where deferred inflows of resources comes in. Think of it as a holding spot on the balance sheet. It's not revenue yet, even though they have the asset, because some condition hasn't been met.
Okay, a temporary holding place. Makes sense. So what about the other side? Expenditures. Tracking the money going out.
Right. Expenditures cover all the spending salaries, supplies, buying capital assets, paying down debt.
And when is an expenditure recognized? Is it just when the check is cut?
No, it's generally recognized when the government actually becomes obligated to pay, usually when they record the voucher payable. So it's closer to accrual than simple cash payment.
What about buying, say, office supplies? Is that handled differently?
There are a couple of ways. The purchase method is common. You record the whole expenditure when you buy the supplies. Then at year end, you count what's left and note it as an asset.
Okay.
The other is the consumption method. Treat it like inventory, record an asset when bought, and then expense it as the supplies are actually used.
And these expenditures get broken down quite a bit, don't they?
Oh yeah, lots of detail. They classify them by fund, then by the function or program like public safety or health, then by department, activity, the character of the spending.
Character, like operating versus capital.
Exactly. Current operating costs, capital outlay for assets, debt service payments, and finally down to the object class like salaries, supplies, utilities. All that detail is vital for transparency.
Okay, let's tackle the big stuff. Fixed assets like buildings and long-term debt like bonds. This seems like another major departure from business accounting.
It really is.
When a government fund buys, say, a fire truck, you're saying it's just recorded as an expenditure right then and there.
Correct. In that specific governmental fund, it's a capital outlay expenditure. Full stop.
No asset on the fund's books. No depreciation over time within that fund.
Nope. Remember, the focus is on the flow of current financial resources. Buying the truck uses up those resources now. The asset itself, the truck, gets tracked on the government-wide financial statements, which use full accrual but not in the governmental fund itself.
Wow, okay. And long-term debt? Similar logic.
Very similar. When the government issues bonds and gets the cash, that cash coming in is recorded in the governmental fund as an other financing source.
So not revenue, but like an inflow of resources from borrowing.
Precisely. And crucially, the actual long-term debt liability. It doesn't sit on the governmental fund's balance sheet.
Okay. And when they pay it back, principal and interest.
Those payments are recorded as expenditures in the governmental fund when they're due. Expenditure principal, expenditure interest, again, tracking the outflow of current resources.
What about leases if they lease equipment or building?
Leases get classified. For ones that are essentially purchases financed over time, like contracts that transfer ownership, the governmental fund treats it much like buying an asset with debt. They'd record a capital outlay expenditure and an other financing source up front for the value of the leased item.
Mimicking the debt idea.
Exactly. And then the actual lease payments are treated like debt service, split between principal and interest expenditures. It all comes back to that focus, tracking the immediate impact on the fund's spendable current financial resources.
So, wrapping up this deep dive, it seems clear that governmental accounting, at least in these main funds, is fundamentally about control and accountability for current resources.
That's the core of it.
They use this integrated budgeting system and this modified accrual basis, which looks really different from the profit-focused, full accrual world most businesses live in.
It absolutely reflects the different mission, doesn't it? Government's purpose isn't profit. It's providing services and managing public funds responsibly within legal boundaries and budgets.
So when you look at these unique methods, the budgeting focus, modified accrual, how they handle assets and debt, what does that really tell you about the core priorities of governmental financial management compared to, say, a private company?
Well, I think it tells you the system is built first and foremost for demonstrating compliance and stewardship. It's designed to show taxpayers and oversight bodies, here's the plan, and here's how we stuck to it with your money. It prioritizes that accountability over measures like long-term profitability. Something to think about, right?